Welcome to JM Financial Mutual Fund's Equity Outlook. In this short video, we would take a look at how different economic and market factors behaved in the recent past. We will also share our view on the Indian equity markets, which may in turn impact the positioning of our schemes. The Nifty index was up by 6.3% for the month ended March 2025. The Nifty Mid-Cap 150 index was up by 7.7%, whereas the Nifty Small-Cap 250 index was up by 9.1% in March 2025. Sector-wise, Nifty PSE 15.9%, Nifty Energy 11.8%, and Nifty PSU Bank 10.8% were the top-performing indices, whereas Nifty IT minus 1.2%, Nifty Auto 3.9%, and Nifty India Consumption 5.5% were the laggards. Global indices ended the month of March 2025. On a negative note, Dow Jones was down by minus 4.2%. Nasdaq was down by 8.2%, while the Financial Times Stock Exchange 100 index was down by 2.6%. The India Volatility Index, VX, saw a decline in March 2025. It was at 12.72 compared to 13.91 in the previous month, down by 8.6%. The Chicago Board Options Exchange VX saw an increase in the month of March 2025 and was at 22.28 as against 19.63 on the previous month, up by 13.5%. Foreign institutional investor FII were net buyers for the month of March 2025. Net FII inflows were Rs 1,718 crores. Domestic institutional investor, DII, bought stocks worth Rupee 37,586 crores, whereas mutual funds were net buyers worth Rupee 12,622 crores. Nifty 50 forward PE trading above mean PE. Nifty Mid-Cap 100 is trading above one standard deviation above the mean forward PE. A respite for equity markets. Indian equity markets had a positive month after 5 consecutive months of negative returns. The Nifty 100 was up 7%, Nifty 150 by 7.7%, and Nifty Small Cap 250 by 9.1%. The IT sector was the only one with negative returns, while defense plus 24.5%, public sector enterprises plus 15.9% were key gainers. The VIX declined by 8.6% to 12.72, indicating that market perceptions of fear are receding. But will this continue? U.S. government actions are impacting the global economy profoundly. USA's budget deficit crossed $1.8 trillion in fiscal year 2024, 6.4% of GDP, up by $137 billion from the previous year. Further, fiscal deficit was $1.1 trillion at the end of February 2025, that is 61% of $1.8 trillion last year's fiscal deficit, in first 5 months of the current financial year. If the current pace continues, this year's fiscal deficit could likely exceed last year's number. The current government wants to reduce this deficit by the following actions: impose import duties, tariffs to raise taxes, hoping that the exporting companies' countries will bear the major impact rather than the U.S. consumer. Currently, America's total imports are nearly at $4.1 trillion, and a 10% additional duty could increase revenues by $400 billion. A secondary benefit of this additional duty is that it could act as an incentive to manufacture within the USA. Higher manufacturing domestically is likely to increase income levels and reduce trade deficit, which was near $1 trillion in FY 2024. Department of Government Efficiency, DOGE, promises to save considerable amounts by reducing waste in government departments and enhancing use of technology. If this department actually delivers on its promise, then the fiscal deficit could reduce further. However, the redundancies created could increase unemployment levels and impact the economy. It is premature to assess the impact of these reforms. Higher inflows of capital to invest in the U.S. as tariffs begin to bite. It is reasonable that broad-based capital flows begin as companies begin investing to localize manufacturing. It is reasonable to expect capital expenditure to remain strong in the U.S. As per S&P research, corporate capex in the U.S. is expected to grow by 5.8% to $1.5 trillion, which is nearly equal to the corporate capital expenditure of Asia and Europe put together. Capex is anticipated to remain buoyant for IT, oil and gas, real estate and utilities. Capital expenditure in utilities is expected to be a global phenomenon as demand for power increases due to data centers, and modernization is also required to accommodate alternate, renewable energy. If the U.S. actually implements these changes and turns around its fiscal and trade deficit, then there are two aspects that the global economy needs to counter. U.S. trade deficit declining will imply lower availability of dollars, which is negative for asset prices. But lower fiscal deficit could reduce yields on bonds, forcing investors to search for higher returns internationally. USA's reduced intervention in international politics and defense is compelling countries like Germany to increase defense budgets and invest in local infrastructure. It is also making European countries to shift from excessive socialism to higher capital allocation and reducing their investments in international markets such as US. This could also push corporate capex within the EU zone. The current state of affairs implies that all countries will need to promote their domestic economies and push for investments rather than social expenditure as the old global trade protocols diminish and using dollar as the reserve currency becomes difficult. India will need to forge bilateral trade treaties to push its own trade agenda and also use government resources judiciously to promote infrastructure and business rather than focusing excessively on social spending. How will India navigate the current economic situation? The recent budget proposals indicate a shift away from investments to a focus on reducing the fiscal deficit. This will help reduce government borrowings and free up resources for the private sector. Interest costs could remain benign if this continues. Corporate capital expenditure has been in a few areas such as metals and utilities, but will need to become broad-based. Foreign companies are expected to begin investments in a meaningful manner to gain access to the domestic market. India will need to become an easier place to do business to retain this advantage. China's global dominance in manufacturing will continue over the short to medium term as the forces of low capital cost, economies of scale, and a high degree of automation and innovation keep it ahead. However, a rapidly aging demographics and reluctance to procure more from China may help India on the margin. Indian manufacturing remains behind the curve in many areas, with lower automation and technology products being preferred here. Further, if tariffs were to be imposed uniformly, then Indian manufacturing may lose out to China, as our cost of manufacturing is higher. Sectors like the pharma sector depend significantly on Chinese inputs, and disruption or price increases could impact these sectors. India will need to increase incentives significantly in terms of tax holidays and other such SOPs to attract global companies, including Chinese firms, to promote the next level of industrialization. We need to improve consumer sentiment and boost consumption as a sustainable means to promote consumption and investment and higher tax collections. Indian markets had a quick rally in March 2025 on the back of attractive valuations in some segments such as public sector companies. However, volatility in global equity markets is expected to continue as liquidity remains tight due to reasons mentioned above. India's RBI is now moving towards easier credit norms and improving liquidity. Consumer sentiment remains dull and is expected to gradually improve. If fiscal deficit is under check and liquidity conditions improve, then cost of capital could ease. but only if US interest rates decline, as the yield differential between India and US is at the lowest level in recent times. FPI inflows have turned marginally positive after 5 months of intense selling in the secondary market. It is too early to call for a continued inflow as the global conditions remain choppy, but to our mind, the China trade and USA trade is also largely over. Corporate profit growth in Q3 FY 2025 was an acceleration over the previous quarter at 12.6% year-over-year for 3,400 companies as per Economic Times Intelligence Group. As per our study, the profit growth for the top 500 companies, recurring profit growth on a like-to-like basis is 5.4% year-over-year. Mid-cap companies have had an impressive performance with profits growing the fastest at 28.6% year-over-year. We expect this trend to continue and set the base for markets to consolidate. Our portfolio positioning continues to focus on companies that have low debt and higher growth potential. Over the past few months, we have increased our tilt towards domestic-oriented businesses such as non-bank financial companies or quick-service restaurants and platform-based businesses. We have increased our large-cap allocation to reduce volatility due to liquidity issues. We are vigilant of corporate governance issues and any such aspects that may impact the portfolio. There are pockets of value emerging in the PSU and capital goods as well. As the macro conditions stabilize, we will begin to look at these segments of the market as they offer growth at reasonable valuations.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.